DraftKings stock is up 38% in the past year, and in this video, I am going to do an in-depth analysis of the company by looking at the financials, the forecast, some important statistics, using my discounted cash flow model to calculate the intrinsic value of the company, looking at the main risks of investing in DraftKings stock, as well as revealing whether or not I am adding it to a YouTube stock portfolio. Starting with their financials, their revenue has grown very rapidly over the past 5 years, growing from $357 million all the way to $5 billion currently. The revenue growth percentage has been decreasing, which is obvious. As the company gets larger and larger, it is going to be more difficult for them to grow. If we take a look at their profit, this company is currently net income negative, as they have $398 million in losses. However, their losses have been decreasing substantially. And one thing that I really like about this company is that it is free cash flow positive. And they have $359 million in free cash flow. Their margins are very good, with gross margin being at around 38%, and free cash flow margin the past quarters has been between 7 and 8%. But I expect them to be much higher at around 15 or 20% in the next couple of years because of this high gross margin. The only thing that I do not like about the financials of the company is the numbers of shares outstanding. They have been increasing this substantially over the past 5 years. Now, this is very bad for investors because you own less of the company, and we will see later which effect this has on future returns when investing in this company. Taking a look at the forecast, DraftKings is expected to keep growing a lot and reach $8 billion in revenue in 2027 and $2.28 per share in 3 years as well. In order to calculate what returns I will get in the future investing in DraftKings stocks at today's price, I use my spreadsheet. I did a 7-year analysis with low, middle, and high assumptions. And according to my low assumptions, you would get a negative 0.5% annual return on your money investing in the stock at $44 per share, middle 12.5%, and high 24.5%. This also means that in order to calculate the intrinsic value of DraftKings, I am going to put a market average return, which is 10% annually. So this means that the intrinsic value for DraftKings is between $23 per share and $96 per share. And I believe my assumptions are reasonable, as I have the company growing 10% revenue growth annually on my low assumptions, 15% in the middle, and 20% on my high, averaging a profit margin and free cash flow margin of 10, 15, and 20%. And I assigned a P and price to free cash flow at the end of the 7 years of 16, 18, and 20. However, I left the share outstanding change at 0%, but as we saw before, they have been issuing a lot of shares, and if we assume they issue 2% of their shares annually for the next 7 years, the intrinsic value, as you can see, decreases substantially. If you want to get access to this spreadsheet, I'm going to leave a link in the description below. It's very easy to use, as all the calculations are done in the background, so you only need to focus on the inputs that matter. The spreadsheet does not take into account the balance sheet, and DraftKings has an amazing balance sheet, as they have $1.1 billion in cash and $1.9 billion in debt. So they have only $800 million in negative debt, which is nothing for a company that has a market cap of $22 billion. And the main risks in investing in DraftKings are the following. Number 1 is the intensifying competition in online betting, with competitors such as like FanDuel, BetMGM, Caesars, ESPN Bet, and others, which are all fighting for market share. Even traditional casino operators and new startups are entering the digital betting space. So this makes it harder for DraftKings to keep growing fast or stay ahead. The number 2 risk is the number of shares outstanding, which has been increasing, and as I've said before, you own less of the company. If there were 10 shares outstanding and you own 1, you own 10% of the company. If they issue 2 more shares, there are now 12, so you're now sharing the profits with 2 more people. You now own 8.3% instead of 10%. Number 3 risk is that profitability is still out of reach. However, this doesn't worry me a lot because they are already free cash flow positive. Number 4 is regulatory and legal risks. Sport betting is heavily regulated and rules can vary by state or country. New restrictions, higher taxes, or tighter rules around gambling could slow DraftKings expansion. And number 5 is that it is sensitive to economic downturns. However, I believe this could hurt DraftKings revenue, but only in the short term, so I wouldn't worry about this. Now, these are my current holdings in the portfolio. The best one performing so far is SoFi, with returns of 206%. And I am personally not gonna add DraftKings in the portfolio because I like to add stocks that I believe are heavily undervalued. And I believe DraftKings is just fairly valued. I hope you found this video valuable. Let me know what you think about DraftKings stock in the comment, and I'll see you in the next one.